Oh, now I gotta
We're
put my
recording.
tie.
Go right for it. Go for it.
Get my tie on. Good evening, everybody. It's wow. It's October 22nd,
Mm,
and
years
what's that?
flying by. The year is
Yeah,
flying by.
Halloween is like what 9 days away. Like to welcome everybody to. Oh, man, we need to come up with a catchy phrase for this. You know, debt-free life with Scott Forehand or something. I don't know, something like that. We'll do a jingle, but want to appreciate everybody coming and here to learn about debt-free life. Just a little bit of a brief history about it. Symmetry started this program a little bit over a year, well, almost a year and a half ago now. At the 1 year mark, the plans that Symmetry had put in place were going to retire $755 million of our clients' debts. It was going to save them $243 million in interest. And when they're all done, they're going to increase their retirement over $2 billion. So these plans, as I tell people, it doesn't work for everybody, but the people it works for, it works extremely well for. Scott Forehand's going to be conducting the overview and the Q&A tonight. A little bit about Scott. Came to Symmetry 2 years ago, a little bit more than 2 years ago, and since Debt Free Life started, my last count was he had serviced over 60 families. When their plans are executed, they'll be eliminating over $35 million in debt and increasing their retirement by over $100 million. So we're being the presentation tonight's being done by an exceptional person. So Scott, without any further ado, take her away.
Thank you, Thomas. I just wanted to know those numbers that you were quoting out earlier. I think most of that was probably you, wasn't it? Think you had a big part in all that. Hi, Scott Forehand, Symmetry Financial Group. I'm one of the agency owners here, and we're here tonight to talk about debt-free life. I mention this every couple of presentations. I just wanted to go back over this. The Secure Act is a law that went into effect this year, and it effectively eliminates a significant wealth transfer technique that's been used for the last 100 years to transfer wealth from family member to family member. And what it actually does is it creates a window where before, if you had, for example, an old 401k or an old IRA, where your survivorship right was left to your spouse or to your family member, previously you had until the end of your life to take that money. But now with the Secure Act in place, the clock is ticking and you only have 10 years now. So if you, for example, have a 401k and you're leaving it to your child does not have until the end of their life to take those funds. They have only 10 years after your death. So that's another one of the attractive things about a DFL campaign is that we don't have restrictions such as when you have to take the money, when you're allowed to take the money, and certainly the taxable component or the lack thereof is one of the beautiful parts about debt-free life. So without going any further into that, just moving on, you're here as a guest of somebody, or you're an agent with Symmetry Financial Group, and you're just here to learn a little bit more about debt-free life and how it works and what it does. So what is debt-free life? Let's go ahead and start that. What is debt-free life? Well, it's kind of a play on words. And what that means is we're using your debt in the form of a very specific kind of life insurance policy to help you get out of debt. And then using the cash that you would normally be spending inefficiently in a manner that's going to help you eliminate your debt quickly, grow a large retirement nest egg, and then eventually put you in a position to take that retirement in a tax-exempt manner. So when we first start this program, one of the two main questions that we ask is, are you 100% sure you're going to have a great retirement? And I don't know anybody that can answer that question affirmatively yes. And if I could show you a way to get out of debt in 9 years or less, is that something that would interest you? And without you spending any more money. And of course, everybody always answers that question yes. I think everybody wants to, this is one of the biggest, we're going through the COVID pandemic right now, but one of the biggest issues affecting Americans these days is debt. And it's because we are taught from a very early age that it's okay to take on debt. And as we grow older and we earn more money, we're able to take on more and more debt. And all that is it's tightening the shackles of debt and allowing it and engineering it ourselves, engineering our own demise, and really putting us in a situation where the retirement that we should have, we're not able to have. So what this program is designed to do is to get you out of that cycle, get you off that hamster wheel, and put you into a position where you're back in control of your future, back in control of your retirement, and hopefully put you in a situation where you can sleep a little easier at night, knowing that you don't have to worry about whether or not your 401k is going to be there tomorrow, worrying about whether or not the market's going to tank 400 points. And especially if you're getting to that 50, 55 years old time frame, when you really don't have the ability to weather one of those major market drops like we're still recovering from the last time this happened. We can put you in a situation where you don't have to worry about it, where your growth is not going to be affected by the market. So if you're like most Americans, this kind of describes you. You spend about 23% of your money that you make every month on living. That's paying your power bill, your gas bill, your light bill, your car payment, all that kind of stuff. You maybe save 3%. If you have a traditional IRA or 401k with your employer, you save 3. Maybe they're nice and generous and they match 3. You're spending about 34 cents on every dollar on interest, whether it's interest on your mortgage, interest on your car, interest on your credit cards, interest because you forgot to pay Uncle Sam and they want their money. And then the last thing, that big portion there, taxes, 40%. That's what Uncle Sam wants. They don't really care when they get it, as long as they get it. That's why they're so nice and generous with you, allowing you to have those 401ks and defer that interest. So if this describes you, welcome to 96% of the American population. Only 4% of us are doing things in an efficient manner. So that's why there are so many people out there that really do need this program. When we look at the Americans in general, we, in the course of our lifetime, make a lot of money. And the average American makes $2 million before they retire at age 65. And that's a lot of money. That's certainly enough money if you spend it correctly or save it correctly, in this case, that you can retire with a comfortable nest egg set aside. The problem is that most of us don't do that. And most of us just keep kicking the can down the road. And eventually we're to the point where we've got our pension and maybe we've got Social Security and we're hoping that that's going to be enough. But we're realizing pretty quickly on, with the average American only having $60,000 stored in a retirement vehicle, that when you're used to making $60,000 a year and all of a sudden you retire, it's not going to be the same. And unfortunately, you're probably going to get back to that point where maybe back in college, where you used to eat ramen and tuna fish for dinner 4 nights a week, you might be headed back there again. And it doesn't have to be that way. And it doesn't take a long time to execute one of these programs to get you there. And as you can see down there at the bottom, that bottom question, is this the American dream? Absolutely not. This is not what our founding fathers had in mind. This is just where it's gotten. And I'm going to point the finger at the politicians because I can, and they're not here to defend themselves. Love that. So moving on. So this is the traditional way that people spend their money. It's what we talked about earlier. And when you go to those folks, the credit counselors, the debt counselors, they're going to come up with the 6 standard ideas, which are outlined there on the right side of your screen. But the biggest thing that they do, work harder, spend less. The biggest one of those that actually works is the debt snowball. All of those will work to some degree, but the only one that really works with regular recurring result is going to be that debt snowball. So when we are looking at solutions to try to eliminate debt, what we do here with a debt-free life approach is we ignore those saving more, refinance, consolidate, spend less, work harder. And the only one we really focus on is debt snowballing, combined with a concept called infinite banking. And we'll get into that in just a minute. So our way is a better way. And when we look at this from a objective perspective, when I've run as many of these programs as I've seen, the statement on your screen, what if I could eliminate your debt in 9 years or less? That's accurate most of the time, but the reality is a little bit bigger. And what I look at, what I really see over and over and over again, it's not 9 years or less. It's 15 to 27 years early. And that's a critical thing, because most people that have a mortgage out there are looking at a 30-year run to eliminate their debt and have zero left over at the end. Or worse yet, they've got student loans, in which case you're looking at, in many cases, a 40-year run to get down to the point where they're debt free. So here's what we're trying to do for you. We're trying to move you from the left side of the screen, where everybody is right now, to the right side of the screen. We're trying to increase the amount of money you save by 500%. So if you look at the traditional American and saving of $60,000 a year, the amount of income you can generate from that, which is finite, might be $4,000 or $5,000. And that's, if you're trying to create a long-term financial plan, that's not a lot to work with. But if we increase that $60,000 to $300,000 a year, that's a different story. Now we're talking $15,000 to $20,000 a year in a tax-exempt environment, and that's significant. That's like that's the equivalent of having a $25,000 or a $30,000 a year salary taxed. We're going to decrease the amount of money you spend in taxes over time by what is, left to right comparison 10%, but what does that really represent? That means we're going to decrease the amount of taxes you pay over time by 25%. And where's that money going? Straight to your pocket, either in the form of your retirement savings or in the form of an increased lifestyle, which you can see there going from 23% on the left side of your screen to 33%. That's actually a 43% increase in lifestyle. So let me put it to you this way. Think about this. You know where your current finances are right this minute. And if you go into the situation where at the end of every month, you've got $400 left over every month, if you were to increase that by 43%, okay, that means we're now almost at $800 a month. What's that look like? And just in that just simple math, that means I've got twice as much money left over every month. That's a lot of money to a lot of people. And whether you make $25,000 a year or $250,000 a year, that's significant. And that's something that will make a difference. It will change your life. It will change your lifestyle, and it'll probably make it a heck of a lot easier for you to sleep at night, not having to worry about whether or not you're going to have enough money next month to pay your mortgage, put food on the table, pay your power bill, keep the lights on, pay your cell phone bill. Last thing we're going to do here is we're going to decrease the amount of interest you pay over time. This is a critical part of this equation. So you can see left side's 34%. That's what you're paying right now. But what we're going to reduce that, by 35%. We're going to bring it down to 22%. And that's huge. That's a huge change. And again, all we're doing, we're not having you make any more money than you're making right now. We're not having you create another bill that you're paying right now. All we're doing is we're going to change the way you spend money so that you get that decreased interest and decreased taxes, and retool and retask and refocus that money so that you get that increased retirement savings and that increased lifestyle that we all look for. So how are we going to do that? Well, eliminate debt in 9 years or less. That's huge. If you have a 30-year mortgage and we can eliminate 21 years of those mortgage payments where you're paying interest most of the time, that's a lot of money you're saving. We're going to reduce the taxes you pay over time. How? Because we're going to put this in a retirement vehicle that is not going to be subject to IRS taxation when you take it. We're going to improve your monthly cash flow. What do you do with that money? It's entirely up to you. You can really amp up your retirement. You can go take trips, go see family. I know we're all clamoring for association these days because of COVID. We're going to reduce the amount of interest you pay to your lenders. That's a critical piece. And we're going to allow you to retire with that tax favored income. And I don't know any more tax favored income than a tax exempt income, which is what we're aiming for here. So one of the reasons, one of the critical things about what we do here is we plan for the unexpected. And if you look at some programs that have come before us, that's what we did. The concept is not new. Infinite banking has been around for a while, and true debt snowballing has been around for a while. And other folks and other groups have made efforts to put those two financial instruments together in one package and create a solution to help do what we're doing here. The problem before us, though, is that every one of those systems that came before this one, that came before the Debt-Free Life program, every one of them fails for one reason or another at some point. The average program before us fails within 12 years. And there's a number of reasons why, and I'm not going to get into all the different problems with all of those other vehicles, but the primary thing that we see for most of those is the emergency fund. And what we do here is we create a 20% cash value emergency fund that you won't see. It's not going to show up on your report. It's there, and it's there for what we are looking for true emergencies, not a I need to buy a new jet ski emergency. A true emergency. And we don't want you to touch it. We don't want you to think about it. We don't want you to look at it unless it's a true emergency. All right. So that's why it's kind of hidden. And that money is always going to be there. And that money actually creates part of our growth that we're going to look at in just a second. So there you go. Let's talk about growth. So we ran the numbers for this system, a tax exempt system, when we compared it with a tax deferred system, like a like a 401k, a traditional 401k or a Roth. And where the numbers play out, and there's no way around this, that it can't play out this way. We're looking at 28 year run on a standard $10,000 investment, whether it's a tax deferred or tax exempt vehicle, the numbers are all the same. Same amount of time, same number of years, same interest rate, same taxation rate when you take the money. And the end result is the tax-free method is always going to come out ahead, simply because that tax that you are deferring, it's growing too. And the federal government is not going to let you get away with not paying it. They're allowing you to grow their income. That's why it's there. That's why the 401k tax exemption exists, because they know you're going to be building cash for them later on in life. So what we do when you look at it and compare these different types of retirement vehicles, without a doubt, hands down, the tax exempt vehicle is always going to outperform a tax deferred vehicle. So let's talk about debt-free life, get a little bit deeper into it. Debt-free life is broken into three parts, three times, if you will, three phases. The first one's called the maximization phase. What we do in that particular segment is we're eliminating your debt as quickly as we can. Rest assured, there is only one best, fastest way to do that. And you can give me your information and I can't tell you what that is, but I have the software that can tell you that is, which is just like every other Symmetry agent that gets certified to do this and takes the training and buys the software can also tell you. So the maximization phase is designed to get you out of debt as quickly as possible. The accumulation phase, this happens before you retire, but after you're debt free. So the accumulation phase is going to be able to generate significant amounts of tax-free growth over time. And that's why it exists. That's why we use it. And hopefully the longer the accumulation phase is for you, the more it's going to grow for you. But I will let you know, I've run these programs on people up to 75 years old. So if you're just starting, it'll still work. Last is that distribution phase. The distribution phase is specifically when you're taking your money. That's when you have the opportunity to take that tax, that important, all important trip that you've been waiting on, or you want to go buy that second home down in Florida or whatever. The distribution phase is your turn, your option, your ability to take the money out in a tax exempt manner. And that's where this is all headed towards. That's the whole goal with this whole program, is to get you to the point where you've got a tax exempt income when you're retired. So I mentioned that this has been around for a while. Infinite banking is not a new concept. It's been around for 100 plus years. And these are just some of the people that you probably will recognize that have done this. Ray Kroc did it with the first, I think, 16 or 17 McDonald's properties that he bought and built. Warren Buffett still does it to this day. Walt Disney did it when he was building both Disney World and Disneyland. And Doris Christopher did it when she started Pampered Chef. So this is not a new concept. What's changed over time is that previously, in order to execute one of these programs, you had to have a lot of money, because in the end, what we're looking at here is we're looking at a regular occurrence of a carrier paying you more interest on the money that you've got stored with that carrier than they're charging you to take a loan using that money that you've got with them as collateral. So it's called positive arbitrage. And that's the goal here. So the goal here is to generate income, generate growth on money, never use our money, but use loans from the carriers. And I'll show you that in just a second, to use that to pay off our debt. All right. So moving on. So we're using a life insurance vehicle. I just mentioned that a second ago. And the other part of this, that's the infinite banking side of this. What we're doing is we're actually creating an environment where the money that you spend, that you'd be normally spending anyway, the money you're spending is being spent more efficiently, so that we can skirt the area around the taxation, get around that, eliminate the interest, take loans, but repay the loans with a relatively rapid fashion. Oh, I got the hiccups all of a sudden. Sorry. And one more thing I want to see this last one down to the second to last bullet here: finance future purchases. Under no circumstances should you feel like if you execute one of these programs that you're stuck, because you're not. And the idea is, and I've seen this over and over and over again, actually making that additional purchase, adding that new debt into your program will, in most cases, actually make your program work faster. It's convoluted. It's really counterintuitive, but it does work that way. And I'll talk about that in just a minute also. And finally, don't forget, at its core, this whole program is still a life insurance policy. It's a specialized kind of life insurance, but it's still life insurance. So when we're looking at these things about creating this this rapid, safe, secure growth that we're able to tap into whenever we need to, and certainly use it as a tax exempt income stream when we're ready to retire, or if we're not. At its core, it's still life insurance, which means there's going to be a life insurance policy with it. And in most cases that I've seen, that life insurance policy grows and it gets to the point where it becomes a juggernaut. And whether you're still funding the program or not, it still grows. So what we're talking about here is the creation of a legacy for your family. Sometimes one, sometimes two, in many cases, it's generational wealth creation and preservation. What I mean by generational, I mean all of a sudden at the end, you're actually creating an income stream for your great grandchild. It's possible to do that with these programs. All right, moving on. So when we first came out with this original slideshow that you guys are seeing right now, these were some of the folks that we helped originally. Obviously, those numbers are much lighter now that we've become more astute at using these programs, and eliminating $73,000, $84,000, or even $100,000 in debt is nothing anymore. It's insane how well this program works. And again, we're not looking to create another bill for you. We're just looking to change the way you spend money. So let's talk about that for a second. How do you spend money? This is how you spend money right now. You make your money. You work your job, whether you're an hourly or salary or even a 1099 or commission sales, whatever. You make money. You make that money and it gets deposited into your checking account. That's your income. And then that money sits in the checking account, and your bank, whether it's Wells Fargo, Citibank, Bank of America, your money's sitting there. And maybe that bank is really, really nice, and they'll say something like, you know what, you've got enough money in our bank that we're not going to charge you to keep your money in our bank. Excuse me? Yeah, we're not going to charge you to keep your money in the bank because you've got over $2,500. Okay, great. What they don't tell you is they're going to be lending your money out every night. The average dollar that you put into that bank gets lent out 7 times before you actually get to use it. And check your balances, folks. How often do they give you a piece of the pie for the money that they're making with your money? And it's very rare, if ever. So the point that we're getting at here is this is going to be an opportunity for you to take this away from the bank, to make it so that you can use your money. And that's what this whole goal is. So finishing this scenario, how you're currently spending money, you make your money. Now all of a sudden it's time to pay that bill. And you tell the bank, either by writing a check or going into your bill pay system, hey, I want to go ahead and pay my credit card payment for the month. So then they make that credit card payment. And then what happens? Your money became their money. Your money's gone. If you're really nice and ask them really sweet, can I have my money back? The answer is going to be no. It's not your money anymore. So what happened is you transferred your money to them, and in the middle, the bank made money with your money, and now all of a sudden it's gone. So there's a better way. And so that's the debt-free life method. And this is how that works. So you're doing the same thing. You're making money, working your job, salary, hourly, whatever. You deposit your money, your income into your bank account. And here's where we go off the rails a little bit. We're taking that money out of that account from our checking account, and we are paying a life insurance premium. Remember, I told you at the beginning, this is at its core, it's a life insurance policy. It's a specialized type of whole life policy. Okay. Specifically, it's what's called a participating whole life policy, which means you get to participate with the company's profits. So if anybody has any illusions about the most wealthy types of companies on the planet, you're going to see a lot of those names that are insurance companies. And if you think about this, who do banks invest in? Banks invest in insurance companies, and insurance companies are the largest institutional investors on the planet, by the way. So let's look at this now. So now we've made a payment from our checking account. We've paid the life insurance carrier that we have our life insurance contract with. We've paid the premium for that whole life policy. But here's where we change things a little bit. We've added 2 additional riders to that whole life policy. One is a term life. Most people know what term life is. It's just additional life insurance that lasts for a specific period of time. But the purpose of that whole life policy with the term life rider creates an umbrella. And that umbrella allows us to put additional cash into the program. Most people understand that whole life policies build a cash value. Most of the time, the rate that it builds a cash value is similar to or less than what you would get as an interest rate on a savings account at your bank, okay, or less. Sometimes it's zero. But in this scenario, these programs are participating, so the rate that the whole life cash value grows is significantly higher. As an example, Bank of America, the rate at which the whole life policy grows here is 16 times what you're going to get in a growth rate from Bank of America. And that's not abnormal. So the purpose of that term life rider, again, is to create that umbrella where we can grow cash value underneath without restriction. Why? Because the IRS says, tax code 7702, IRS says, any cash, funds, money derived from a life insurance policy is tax exempt. So that's this loophole that the wealthiest people in the country have been doing for years to transfer wealth from generation to generation. They're using life insurance policies to do it. The IRS tax code also says if the cash value of a life insurance policy exceeds the life insurance value, that policy then will become what's called a modified endowment contract, and then the entire thing becomes taxable. So you lose. So the goal here is to avoid becoming a modified endowment contract. And the way that we do that is we add that term life rider to create that umbrella so we can have that room underneath to throw cash. Okay. Now, third part. Here's the second rider, and this is the most important part. There's a paid up additions rider. So there are 4 standard kinds of life insurance: term life, whole life, universal life, and straight life. Okay. Straight life is nothing more than the plain death benefit life insurance. However, in this case, paid up additions is a straight life type of policy. Okay. So once that policy is paid for, once that paid up addition is paid for, that's additional life insurance that you have. And it's permanent. So when a bank looks at a paid up addition life insurance policy, they see it for what it really is. It is a wealth transfer vehicle. It is it has a permanent value. If you buy $1,000 worth of paid up addition life insurance today, it's worth $1,000. It's worth $1,000 tomorrow. It's worth $1,000 10 years from now. It's worth $1,000 30 years from now if you're still alive. And when you pass, it's worth $1,000. So it has a permanent value that will not go up or down and cost zero to maintain. That's why banks love paid up addition life insurance policies, life insurance in general, as an investment vehicle, which is why if you look at Wells Fargo, for example, Wells Fargo has 48% of their assets structured in tier 1 assets, which life insurance is considered a tier 1 asset. And specifically, they have 48% of their holdings stuck in life insurance policies. There are companies that are out there called viatical settlement companies. That's all they do. They go around buying up people's life insurance policies. They pay them pennies on the dollar, and then they get this massively valuable, at some point in the future, life insurance policy. So, what have we done so far? The difference between what you do and how you spend money now versus a DFL is we're diverting some of the money that you're spending every month, and we're paying for a life insurance policy. But more importantly, when I look at those three ways that the money gets split once it hits that carrier, 22% of that's going into that whole life policy. About 10% is going to pay for that term life rider, or maybe less. And about 68% is going to go into that paid up additions rider. And that 68%, we'll use $1,000 as an example. That $680 is cash value? No, that $680 is asset value of your policy. And that is immediately available for you to take a loan against. And you can take that loan. And I'll show you that in just a second. So what's really happened? That little circle that used to be around the bank, where the bank was making money with your money every time, where your money was stuck in your bank, well, we've moved that circle and your money up into your private bank, into your DFL bank. And now we're making money with our money every night, as opposed to the bank making money with our money every night. How much money does this thing make? Well, as a general rule, you're going to get 4% interest guaranteed. On top of that, you're going to get a dividend paid annually. Those two things compound depending on which one of the carriers we use. We have three, either monthly or annually. So now let's see, we've moved through time a little bit. So we've made a couple of payments. We've made two payments. So we've got $1,360 in our paid up additions segment. And now it comes time, you know what? We've got that one credit card. We've paid it down to $1,200. Let's pay off that credit card. So now, instead of pulling money out of our program, let me be very, very clear about this. Do not pull your own money out of the program. That defeats the program. It doesn't make it work the way it's supposed to. The cash that's in here is emergency cash only. Don't touch it unless it's a real emergency. You have other vehicles, other ways to get the money out. And the way that we're going to take the money out is we're going to look at that $1,360 that we have in our paid up additions component. We're going to take a loan for $1,200, deposit that money as a carrier loan directly into our checking account. And then we're going to tell our bank to go ahead and pay that debt. And we have our bank send $1,200 to the carrier, or to the lender, the creditor, and pay off that debt. So what just happened? I just paid off my debt. Debt's gone. I don't owe it anymore. Whose money did I use to pay that debt? I used the carrier's money. I did not use my money. I did not pull my money. All I did was tell the carrier I'd like to take $1,200 out of my program using my paid up additions as collateral. This is just like going to the bank and putting in a CD, buying a $10,000 CD. They will be happy to lend you $10,000 the next day because your money is safe and secure in that CD. Same thing here. The only difference is we're actually going to still make money. The average, when we're looking at this, a 4% guaranteed return plus a dividend, which I've seen as high as 8%, means that the loan rate that we take out is going to be less than the average combined interest rate plus dividend, which means we now have positive arbitrage. So we're making money with our money, even though we're borrowing against it. So how does this work as an example? So I'm going to show you what one of the families that I worked with back in last October. This is a young family. Both the husband and the wife were previously married, so they had two houses that they were maintaining. One was a rental property, and one was their primary residence. The woman was a PhD student, so she's got a lot of student loans. They also have some other debts. The gentleman, the job that he worked was a 1099 job, so he had some tax issues that he was still taking care of. They have two new vehicles that were relatively expensive vehicles, and they've got other things that they're doing, credit cards, stuff like that. Standard American family, fair amount of debt. When I asked them how much debt they had, they said, we think we have just over $500,000 worth of debt. And that's accurate. However, That's only accurate if they have the ability to stroke a check for $585,000 and pay it off in one day, which they did not, which means their debt is financed. So if their debt is financed, is there any financing company that's going to charge you a financing fee but not make you pay their interest rate? Nope. So the reality for them is their true debt was $767,000. And when I say true debt, I mean on the track that they were on, it's $767,000. So they were going to be in debt for 40 years because a lot of that debt, over $100,000, was student loans. But what we did is we got them out of debt in 7.8 years. Now, look, to do this program, I did not create a new bill. All we did was look at what they were currently paying, figure out what they were overpaying, look at the amount of money they were putting into their 401ks. Let's talk about that for a second. Is there anybody out here that thinks that the interest that you're going to be paying income tax over the course of the next 10 or 15 years is not going to go up? Does anybody think taxes are going to go down? Right? So if you were told about 401ks years ago and you bought into that, which I did too, where they said, put your money in your 401k now. You don't pay the interest on it. Don't pay the income tax on it. Pay the income tax later because you'll be at a lower tax bracket, right? Right? Nope. You might be at a lower tax bracket, but you are not going to be at a lower tax rate. So it doesn't make any sense anymore. The 401k illusion has been broken. If you put money into a 401k, what you are really doing is you're paying less tax on it now so you can pay even higher taxes on it later when you pull it out. So back to this. So what we did here is we repurposed some of the money that they were putting into a 401k because they got and understood what I was talking about, how they're going to be paying higher taxes later. One of the things I want you to take a look at here real quick, this percentage rate, that's the interest rate on each one of these debts for this particular family. You'll notice something. I talked about debt snowballing, which is this program uses debt snowballing. But a lot of people think that debt snowballing is taking the highest interest rate, whatever, and paying that off first and then going to the next and then going to the next. That is completely inaccurate. That's called debt stacking. And 99 times out of 100, if you compare a debt stacking routine to a debt snowballing routine, the debt snowballing routine will come out way, way better. Either the debt snowballing routine will come out way better or they'll be exactly the same. That's the only time. But a debt stacking routine will never eliminate debt faster than a debt snowballing routine. So if you look here, the highest interest rate thing these folks had was a credit card for 25.24%. But yet that wasn't the first thing they paid off. And that's because we're using true debt snowballing. And debt snowballing says there's a best way. There's only one best way to get you out of debt and the fastest. And that is to eliminate the interest, yes, but build the debt snowball as quickly as we can. That's how this program works. So for these people to do this decision, make the decision to do this, they were going to be in debt for 40 years. They were going to pay $182,000 in interest. At the end of that 40 years, they were going to be debt free. Great. And have nothing but the equity in their two homes to show for it. Using this program without spending any more money than they're already spending, just changing the way they spend money. That's all we're doing, okay? Not creating a new bill. They were able to get out of debt in 7.8 years. They saved over $70,000 in interest. That $70,000 went right into their pocket. More importantly, when I asked them the question, do you want to do this or not do this? The question is very simple. This is your cost to not do this program. At the end of their 40-year run, with this program, they would have $4.8 million liquid. So their cost to not do this program was $4.8 million in additional retirement that they were going to have. More importantly, when you look at the fact that, don't forget, there's a death benefit here too, right? There is a whole life policy that becomes fully paid up that you never have to pay for again the rest of your life, right? So when you combine the death benefit and the cash value, the liquid value of the program, for them not to do this program, it was $5.9 million of loss. That's what they would have lost if they hadn't done this program. Here's how it worked. So every one of these yellow bars is a year in which one or more debts were paid off. So in the first 3 years, they paid off a lot of debts. The fourth year, there wasn't enough money. So what's left at that point? There's only 3 debts left on this particular scenario. One was a student loan, one was a rental property, and one was their primary residence. The primary residence started off at $215,000. Remember that, because we're going to show that to you later. So in this scenario, at the end, 7.8 years, which is the 8th year of the program, they are debt free. Now, one of the questions I get all the time is, but I've got a loan, right? Yes, you do. And I have to pay back the loan, don't I? No, you don't. What? Yes. You mean I can take a loan and not pay it back? Yes. So let me turn the question around for a second. Who's lending the money? The carrier. Who makes the determination of whether or not you can have the loan? You do. This is your bank. It's your private bank, right? So I make the decision of whether I'm going to lend myself the money or not. I also make the decision of what I'm going to charge myself when I pay it back, or how I pay it back. This program is designed for the loans to be automatically paid back over time through the combination of the annual or monthly compound interest plus the dividend. So if you pay into the program and get the thing funded and get out of debt and then never make any more payments, the fact that you've got all that cash in there that's growing at the 4% plus a dividend every year, that will eventually pay your loan off. Okay. But more importantly, in this program, that's not how we did it. We used the debt snowball. So once all of their debts were paid, we continued paying money back into the bank. And then the bank eventually in this period, in this example, in 2 years, paid all the loans off. So they paid off $585,000 worth of pure debt, plus about $110,000 in interest over 10 years. And look at this. At the end of that, what do they got left? On the 11th year, when they are debt free, they still have $375,000 liquid, $375,000. So when I asked this gentleman when he wanted to retire, he told me, well, I own my own company. I'm going to retire at 72 or 75. And I said, okay, that's fine. It doesn't have to be that way though, but that's fine. So when we ran these numbers, I ran him at the 75, but I also showed him at 65 years old, if he wants to, he can retire at 65. And he'll have $3 million liquid sitting in that program. More importantly, he'll also have $2.8 million in life insurance. So even at 65, if he wanted to discontinue making payments on the program, he certainly could. There'd be a very, very large generational wealth producing death benefit on top of a very, very large cash value, $3 million. Anybody have any idea how much money you can make with $3 million in the bank per year? 150,000, easy. That's a 5% return. No biggie. That's easy to find. You can actually make more than that if you want. But in this scenario, look at this. $3 million. Oops. $3 million in that year, $3,177,000 the next year. That program grew $165,000 in 1 year. And we only contributed $10,600 to it. So what I'm getting at here is this gentleman can retire at age 65, and he'll be making $150,000 a year or more tax free for the rest of his life, not contributing to the program at all. It's on autopilot. And that's where we try to go with these programs. Will it work like this for everybody? No. This family makes a lot of money, so they can afford to fund this thing the way that they are doing it. But don't be confused. We're not spending any more money than they're not already spending. All we're doing is changing the way they spent it. So on their current track, they'll have zero left over in 40 years. Using this program, in 40 years, they'll have $5.9 million combined cash and death benefit. So what about if you say, you know what? I don't have a house. Okay, here's an example for a student. So this student is a 23-year-old waitress. She's in the master's program at Cal State in oceanography. She will graduate. And when she graduates, she'll go in and get her doctorate. But in the meantime, she's building up a lot of debt, right? So at this point, she's already $90,000 in debt as a college student. And this is just mostly from student loans, and she's got a car payment and stuff like that. So if she stopped right now and didn't take on any more debt the rest of her life, and also never made more money than she's making right now as a waitress, this is where she's at. In 40 years, she'll be debt free. she's going to pay more in interest than she's going to pay in principal. That's the beauty of student loans, folks. Don't do it. They're evil. So her real debt is 177,000. Her total core debt is only only 85,000. So she's not in good shape. And granted, that's the trade-off. When you go to college, it's expensive if you can't afford to work your way through it. So what we did was, on a waitress's income, $350 a month, folks, we got her out of debt in 9.7 years. We saved her $64,000 in interest. But more importantly, in 40 years, so when she's 63 years old, there'll be $603,000 cash sitting in that program. And there will also be a $400,000 paid up life insurance policy for her family. So we created $1 million in family wealth for her for $350 a month right now. Amazing, crazy stuff. More importantly, there's a lot of more importantly. Everything's important, right, Tom? So in this scenario, I've got her. She said she wanted to retire at 65. I've got her retiring at 56. So at 56, she's no longer making any more payments into the program. She's got a death benefit built up of $685,000 that she's not paying for anymore. It's a fully paid up life insurance that grows every year. It's going up $6,000 a year. And she's got $409,000 sitting in the bank, which is growing at $22,000 a year. So at 56, if she wants to take income from this, she can. She can take $22,000 a year income tax-free for the rest of her life, or she can let it all sit in there and grow. It's entirely up to her. So we gave her options. Incidentally, at 65, she'll have $658,000. That's if she doesn't touch it. And her death benefit will have grown to $740,000. It's on an automatic pilot, people. Can't defeat it. It's a juggernaut. Unless you want to cancel the policy and then take cash value out, in which you certainly can, and there's going to be a lot of it in there. So that's the end of the basic presentation. So at this point, if you're here to look at debt-free life as an option for you, you should get with whoever invited you. And maybe there's a document that you can fill out, which is just a financial analysis to determine what kind of debt you have, how this program will potentially work for you, and then we can get some illustrations out to you. I want to go into a little bit more now, and let me do this. I'm going to share a different part of my screen. There's lots of different ways that you can fund these programs. You can use repurposed overpayments of debt. You can use overfunding of 401ks, traditional 401ks, IRAs, TSPs, FERS, whatever. You can use repurposed money for things that you never thought of. And that's what I'm going to show you right now. So let's talk about that for a second. Most people that we run into have a mortgage. And on those mortgages, you are required to pay your principal and your interest to your lender. And the principal and interest payment make up most of the premium that you're paying every month. You may also have what's called PMI, primary mortgage insurance, and that's if you've borrowed more than 80% of the value of the property, there's going to be a PMI payment also. Depending on which type of loan you have, whether it's a Fannie Mae, Freddie Mac, conventional loan, FHA loan, VA loan, there may be the option for you not to pay your taxes and your insurance payment into escrow. So this is one of those things when I talk to people who are, and I used to do this when I was younger too, I would say, yeah, I'm going to claim zero. So that way I get more money back from the federal government every year when I get my tax return. Okay. Back then it was basically a forced savings account is what I was using it as. And in that scenario, as a forced savings account, I was earning zero with that money, but the federal government was happy to take my money and happy to give me that income tax return later on because they've been making money with my money. So if you think about the taxes and insurance payment escrow that most people pay with mortgages, it's the same thing. If I don't have to pay my taxes and my insurance payment to my lender, if I can do it on my own, if I can pay my taxes directly to my local municipality and pay my insurance payment directly to whomever holds my homeowner's insurance policy, then why wouldn't I? That way I can take that money and I can do something with it, right? So I just wanted to illustrate to you folks what that means and what it looks like. So I did this last week, but I've updated the numbers to be more accurate and filled in the gaps. So here we go. So this is actually one of my clients that I worked with 3 weeks ago. This is his actual mortgage. He pays around $1,700 a month. $888 is interest, brand new mortgage. $300 is principal. He's paying $168 in taxes, $310 in insurance, which means he's paying $478 a month on taxes and insurance, which means over the course of a year, he's paying into his escrow $5,736. The bank or the lender is making money with that money every time. They're certainly not sharing it with him. Okay. So what happens if I take that money and I use that as a funding source for my debt-free life campaign? That means that by default, every year, I'm going to be putting in $5,736 each year. Each year is a critical thing, each year. Okay. I'm going to make $229. That's the 4% guaranteed return. I'm going to make more than that, but that's all I'm illustrating is the guaranteed return. That's before the dividend. I'm going to make $229. Now, when it comes time to take out the loan to pay my taxes and my insurance payment, I'm going to pay $273. So in the very first year of working this program, you will have a loss. The loss is $44. $45. That's year one. Can everybody see that? Somebody nod their head if you can see what I'm talking about. There you go. I got a nod. All right. So that's year one. Now, if you're running this program and you're using this the way that debt-free life programs are structured, then you've got other debts, which means you're going to have a debt snowball. Most debt snowballs start in the first year. And by the second year, the debt snowball is becoming a juggernaut. You'll end up, if you start off at a $300 a month program, by the end of the second year, your $300 a month program with the debt snowball has grown to like $1,000 a month, and you're buying a tremendous amount of paid up additions every month, right? So by the second year, the $45 difference in loss that you're going to have by taking this loan is gone, because you're going to be paying that loan off every year. You're going to be paying off the previous year's loan. In addition, you're going to be paying in another $57.36 combined with the year's total before, and then having a 4% interest on top of that. Then that means on the second year, you're actually making money. Okay. This is how much money you're making with the program. That's beyond the just the growth that's happening because you're adding in the 57.36. So in year 3, you're making 400 and change. In year 4, 690. Year 5, almost $1,000. This is doing nothing, folks. Nothing other than what you're already doing. Instead of sending your lender the money to pay your taxes and your escrow payment, you're sending it up into your private bank, letting it sit there, letting it grow, earning interest, earning a dividend, and then pulling the money out in the form of a loan and paying your taxes and your insurance when you need to. This is just a smarter way to spend money, people. That's all this is. But look at this. Now, let's say you escalated through and you ran this program for your debt-free life program, and you got out of debt in 9 years or less. So you don't have a mortgage anymore, but your taxes and your insurance payment aren't going to stop. It's going to keep going. So why shouldn't you keep the program rolling? So what I'm showing you here is in the 15th year, let's say you have your house for 30 years, this is going to grow and grow and grow. This is putting an extra $120,000 into your retirement account. That's earning at this point, that's an extra almost $4,500 a year, every year. That's at the 15-year mark. At the 30-year mark, this thing's crazy. The 30-year mark, you're earning, and just by making your taxes and your insurance payment into your DFL campaign, you're making $15,000 or $20,000 a year, every year. And if you stop, no problem. It's still earning, it's still growing. It's on automatic pilot. So this is just another funding method that you can use that does works like a charm. I love it. I'm doing it with my family and pretty much all the clients that I talk to. If they are not in a FHA loan, then we're looking at this as a funding strategy for their vehicle as well. Okay, so now I'm going to shut up for a minute. I'm going to go down to, oh, we got no chat, got no questions. That makes it easy. All right. Let's see. Let me go back to this. So if anybody has any questions, unmute yourself and ask away. Hey,
Scott, how you doing?
Hey, David, how you doing, buddy?
I'm doing great. I got a question for you.
Hit me.
All right.
Hey, David,
potential. Oh, I got a little feedback. I'm sorry about that. Let me disconnect and I'll try again. Or can you hear me just fine?
Now you're fine. Just don't sit so close to your mic. Now you're fine. Just don't sit so close to your mic. Oh. All right. That might be Colleen. There you go.
It's all right. What about someone who has a, and I don't want to say the word replacing a policy. We don't want to do that, right? But they have a.
I do it all the time.
Do you? Okay. This one is a flexible universal life. So she accumulated a cash policy, or a cash value, I mean. How are you illustrating that into your, like, as opposed to taking that cash and using it as a one-time lump payment?
Right.
Towards, like, say, a debt-free life illustration.
So that's a kind of a deep question. I don't illustrate it, and if we can, I'd rather take that question offline because I don't want to confuse anybody who's just getting started with that one. But there's a way to do it, and just as the short answer is, I wouldn't use that policy. I wouldn't replace it. I would use that policy as a pre-bank, because in most of these cases, we're going to be putting too much cash in here to be able for one bank to hold it. So I'm going to have a place to run off the money to. So if you've got a UL, fixed UL, as long as it's not a variable UL, then I would probably look at keeping it. Okay. But you can,
sounds good.
Yeah. Send me an email or call me and we can talk about it directly.
Sure, Scott. Thank you.
All right. I think Colleen, you had a question. So go ahead and unmute yourself. Oh, there you go. There you go.
Yes. Well, you're already structured with your refinancing and that tax and insurance is coming out. How do you modify that contract?
So you
and
don't.
I wondered,
Yeah. So
secondly, in terms of life insurance, where you can't.
Yeah, so here's how this works. If you're trying to execute one of those, moving the taxes and the insurance payment away from having it be part of your regular mortgage payment. Okay, as long as it's not an FHA loan, pick up the phone, call your lender, tell your lender, hey, Mr. Lender, I've decided I'm going to pay my taxes and my insurance payment directly myself. So please stop escrowing the money. Just take the principal and interest payment. That's the first call. The second call, you call your homeowner's insurance policy. You tell your homeowner's insurance company, Allstate, State Farm, whoever, hey, Mr. Insurance Company, I'm no longer going to have the funds for this escrowed. I'd like for you to bill me directly. And then you can work out with them, quarterly, biannually, or annual payments. And then you're going to call your local municipality, same thing. So for me, I live in Chesapeake, Virginia. So I would call the Chesapeake Department of Taxation. I would say, hey, I'm no longer going to have my mortgage company pay you for my annual taxes. I'm going to pay them myself. Please send the bill directly to me. And that's it. Did I answer your question, Colleen? You got to unmute.
Yeah, I'm sorry.
That's all right.
Direct wiring to my system, I found that
Right.
it's not as stable as it should be. The borrowing from your insurance.
Yes.
Taking the equity out of your house or no, and how would you put that back? I wondered about that.
Right. So not that I want to speak ill of other programs that have come before us, but using a home equity line of credit is a common solution that programs like these like to use. And I am absolutely adamantly against giving away equity in my home for something that doesn't deserve equity in my home, like a credit card or a car payment or whatever debt it is. So it may look on the surface as an attractive option, because the interest rate, we're going to pay off a 16% interest rate credit card with a 4% home equity line of credit. No, Yes, you are, but you're also going to be giving away equity in your home, and that doesn't make any sense to me. And the reality is, when you run this program versus those other programs, and I'm not going to use a name, but the program that I think that you're thinking about that uses home equity lines of credits, that program's success is predicated upon a regular increase in the value of the stock market. And it requires 10 out of 12 years to be a positive. And that doesn't happen very often. I think it's only happened twice in the history of the stock market. So those programs will fail. That's why one of the reasons why those programs fail is because it's linked to the market performance and it's using a home equity line of credit as the vehicle. So no, I don't like that. I'd rather use this. This is insulated. A home equity line of credit is a banking instrument, which means you don't have the protections associated with a life insurance instrument, which is why we go here. Tax code 7702 makes a big deal. So I've got a list. I've got about 12 pages of research here about why the home equity line of credit route is a bad way to go. And I'll be happy to share that with you. Just there's not enough time today. It's not a good way to go. So there's a better way. I'm not saying it won't work, but I'm saying that that's one of those ways that will traditionally fail. All right. Did I answer your question, Colleen? Are we good? You guys are making it easy on me.
Thank you.
All right. Thanks, Colleen. Anybody else have any questions? Oh, this is awesome. So you guys got it all. You all figured it out. Hi, Taylin. How you doing? Nice to see you. I missed the palm trees, Tay. There's usually palm trees behind you.
I moved my office. So
did you? No, you're no longer in Aruba?
Yeah, unfortunately.
All right. Slumming it back in the U.S. Well, welcome home.
Oh, thanks.
All right. So give this one more round. I've got 7 more minutes slotted for this. If anybody has any questions, if not, then we can get ready for the advanced market training. It's going to be happening here in a few minutes.
So Scott, this new thing where we're talking about financing their escrow payment. I know that's brand new. You just kind of developed it about 2 weeks ago.
Yep.
Have you written one up yet for that?
Yes.
Yep. How did you break the ice with them?
So here's the good question. So the critical thing with those programs is you absolutely cannot make that part of the initial funding strategy, because that's money. That's not a debt that's ever going to get paid off. So it's just something. So when you're structuring those, you have to make sure that when you're looking at the PUA bank loan capacity, that we have enough room in there to capture that every year. So if the PUA loan is $25,000 a year, just know that $5,000 a year is going to be used for the taxes and escrow piece. And the other part, the critical part with that is you have to make sure that people that are executing that are making that part of their program, that they do not use that money for anything other than paying their taxes and their escrow payments. That's it. Not escrow, but their taxes and their insurance payment. That's a critical piece. So they always have to have whatever they put in. They always have to have that available in their loan capacity to take that loan whenever they need it.
So to get technical, and I know that in 2 weeks you're going to get very technical with this, develop a DFL plan around getting them out of debt in a certain time period, and after locating money in their budget that's not being allocated effectively, then increase the term coverage to allow the total amount of the escrow to come in and not be a taxable event, and then hit them with that.
Right. So this is, okay. Make sure I'm clear on this. This is a funding strategy for PUA. This is not a funding strategy for the policy.
Gotcha.
Okay. So don't confuse the two.
Okay. So it's funny because I just worked on a case for a young lady, and she wants to put $250 a month in, but she wanted the option of putting more in.
Sure.
So we kind of went back and forth about how much more, and I started playing with the term, and she's got enough room in there, and her age is such that it's very economical. for her to put an extra a grand a month in, throughout the year. Now, and I told her that you got to do this. You got to be, when you start doing it, be consistent, because what's it, after 5 years or 7 years, depending on the carrier, they recalculate the maximum you can put in.
7.
Is that correct? 7. Okay.
Yep. That's IRS guideline.
Okay. And so I might have accidentally set this up for her to be able to do that. So
awesome. Good job.
Go team. Go team.
Congratulations.
So, well, Scott, I mean, I don't want to take anybody else's time, but this week in and week out, I don't think I've missed one of these yet. Week in and week out, I walk away with something else that I hadn't thought of before. And I just really appreciate you sharing that massive brain of yours that burned all your hair follicles off.
I know, it's getting shiny, isn't it?
It is getting shiny. I mean, they used to say, I smell wood burning. Now I know what they really mean by that. It's the hair burning.
Right.
But no, really appreciate you taking the time out for all of us, for this. I think that escrow is a no-brainer. It's an absolute no-brainer. I'm just trying to figure out how to breach the subject.
So all it is it's just, what kind of loan do you have? Is it an FHA loan? If that's the answer to the question, wave off, because you can't do anything with it. But if it's not an FHA loan, if it's Fannie Mac, Fannie or Freddie, or if it's a conventional, and you're good to go.
You mean like Quicken Loans and Loan Depot and?
Well, I mean, Quicken Loan does FHA loans, so you have to find out what kind of loan it is. Really, the question is, how much did you put down? Because if it's an FHA loan, those are subsidized loans, subsidized by the federal government. So you're only putting down 3%.
Okay.
And so
you're looking for someone that's not paying PMI. You're looking for someone that owns 20% of their house.
I mean, PMI doesn't matter. I mean, if you have a 90% loan, you're going to be paying PMI, but that's not going to be an FHA loan. So the determination is whether or not it's FHA.
Okay. Gotcha. Okay. Well, I just took a couple minutes, so somebody else say something or ask a question. Okay.
It's okay. All right. Well, I'm fine with closing this one down early. So thank you, everybody, for coming. Hopefully you got something out of this. We are back in 2 weeks, going to do this again. For the agents that are involved, in 2 weeks, we will be doing a 2-hour-long advanced market training immediately following that. Specifically, how do you do these programs from start to finish? The questions you ask, how you fill out the application, how do you run the illustrations, what's the logic behind the different ways that you fund these things, and making and adjusting the bank capacity and all that stuff. So that'll be in 2 weeks. So
by the way, Scott, one last thing before everybody goes.
Okay.
Advice for people that are sitting in on these calls, that are running mortgage protection appointments, but have not had the chance to become DFL certified. What advice would you give them?
Master the mortgage protection piece first, build relationships with your clients that you can come back later, get the certification when it's appropriate. Don't rush it. Okay. But, because the temptation will be this, under no circumstances should a DFL program be a substitute for mortgage protection. It is not mortgage protection. It doesn't work the same way. It doesn't provide or afford the same types of protections. So don't use it that way. And the temptation for new agents that get DFL certified is to go out and start writing everything's a DFL. And that's not the case. Just it's the new shiny penny. You first learn how to do an IUL. Everybody needs an IUL. No, that's not the case, but that's where you go. So just master the basics first. Help the families first with the mortgage protection, because that's where most of the people that we talk to come from.
Okay. Thanks, Scott. Appreciate you.
All right, folks. Thanks, everybody. Have a great night. And for those of you that are in attendance with Dr. McCrae here in, 15 minutes, I'll see you then.
Okay.
Bye now.
Bye, everybody.
Thank
Bye,
you.
everybody.